Really enjoying these office hours every week. Enjoying the feedback from the people, and now that we're putting out the office hours content in more places, we get it on the blog, get it on the social media platforms, it's at the documentation. It's great to see that. I guess my view of AI now is sort of like get your data everywhere, get the information everywhere, and then we'll worry about synthesizing that information into an answer afterwards. So it's pretty cool.
Yeah, obviously the human touch is always going to make a big difference. And I love how much more challenging some of these questions are getting. So keep them coming. Like if you have any specific question about how Traders Post works, specific ways to set up a trade, specific reasons that things happen, we love covering all of this stuff. But beyond that, we love talking about the markets and trading strategy ideas, market thesis, just high level ideas as well. Tom and I will cover everything.
Yeah. Ultimately, I want to get to the point where, and I imagine we'll be doing this, where we're doing certain office hours will be walkthroughs of certain processes. Like this is how you do a thing from A to Z. So that's that's going to be on the roadmap. But for now, I just wanted to mention here something that rolled out on the last week. It was actually after the last office hours, where Coinbase and crypto are out of beta on the TradersPost platform. And so, as we mentioned before, betas we're working out a bunch of the kinks, get in that in the hands of people to see what they think. Obviously, it's been worked on internally for a while before it even rolls out, but it came out and it's pretty cool. For crypto, Mike, how much is crypto like becoming a bigger part of the Traders Post universe? Is it sort of like better to get more TradFi brokers on board, or is there a push to get more crypto in there?
I want to see crypto explode on our platform, no question. I think that there are a lot of people out there that enjoy the crypto space, not just because of the lower cost of entry, right? Like you can place a trade for $5 if you want to, which is more difficult to do in traditional finance, where there's margin requirements that require more of an account balance and so on and so forth. But I started a lot of my automation journey back in 2016 and 2017 in crypto, and I would love to see more people using our platform for the crypto space. I think we can handle it exactly the way that people expect, and it ties well into trading views. So at the moment, we haven't seen a ton of adoption. It still represents probably less than 5% of our overall notional volume of trades. But we are eager to figure out what else we need to do to invite and welcome more crypto traders. I think one thing that will probably help with that is, of course, the broker coverage. So one of our upcoming releases, we're pushing out a couple more crypto brokers. We've got Kraken repairs that are coming up, of course, but then we're actively working on Binance as well, and then eventually Binance US right after. And then any other crypto brokers people are looking for, we'll keep our spotlight on.
Excellent. All right. So one of the one of the first questions that showed up over the last week, and honestly, I had this question myself because I write more strategies for clients than I actually run them myself, and it's this idea of is it possible for forward testing to outperform back testing
Yeah.
within the context of if that is possible, why ever then back test, rely on the back test? Why not always forward test a strategy to see if it's worthwhile?
Yeah. Okay, so back testing and forward testing. The biggest, I think, framework of thinking that I've used and I think is highly recommended within the quantitative community around the whole backtesting concept is trying to reject the null hypothesis. And I know that sounds like wordy and like academic, but here's the thought process. Start with the assumption that it's not going to work. Start with the assumption that your backtest is probably overfit, or simply just grabbing the signals so perfectly that it lines up with historical data in a way that makes your strategy look really good. Or you've only selected a window of time that's just perfect for your strategy and you haven't gone far back enough in order to account for market regime changes. So what forward testing gives us is some opportunity to reject the null hypothesis. And what we mean by that is we're looking for evidence that the proposition that the trading strategy doesn't work is false, right? Meaning, like, we're kind of thinking backwards here. We're assuming it doesn't work, and now we're looking for evidence that it does work, which invalidates our premise that it doesn't work. And by thinking from that perspective, we just spend more and more time trying to collect that evidence. So it's totally possible for a forward test to outperform back testing, depending on what measures you're using. If you're saying, my win rate looks good, my risk to reward ratio looks good, my overall profit factor is correct, I've taken, let's say, 50 to 100 trades in the forward test window, and everything seems to be robust and standing up, and moreover, those performance metrics are better than they were in the back test window. I think as we collect this data, it's always possible that strategies are going to see, performance peaks and declines, and they're going to change over time. So of course, it makes sense that you might have caught the perfect window in which your forward test has better performance. And that might be an opportunity for you to go ahead and start scaling in. Just keep an eye on your strategies, though. As you start to put live capital in front of it, I always recommend starting really, really low with position sizes and then moving up as your performance continues to remain stable.
As I've been watching the different trading bot sessions, hearing this refrain again and again, and not just trading bot sessions, but also other content within the FinTwit space, um, it seems it's really all about risk management. That what you want is the strategy to not blow out your account.
Right.
Right. You want to make sure that that's not what's showing up inside of your back testing or forward testing.
Mhm.
And if you go, okay, maybe the strategy might not perform well, but as long as your capital is being preserved in a reasonable way, then it's then you can test it out. I mean, that's generally the tip that I give to my clients. It's like, what I'm here to do is make sure that this works in such a way that you're not going to lose your shirt because of a technical problem, or that it's not a fundamental flaw in your strategy that would expose you to these tail events, like what uh, one of your colleagues said. He was just saying that the risk management was so important, and that was the thing that once he understood, it completely changed the way that that he tackled the markets, and it allowed him to become more profitable over time. And
Yeah.
it's the refrain that comes up again and again.
For sure. And like I don't know, I remember early on in my trading career, 2015, 2016, I got really into Aaron Fifield's Chat with Traders, and I listened to all of them. I mean, I consumed everything I could. It's one of the most common things you hear successful traders say, was that risk management was a big part of their success. Once they started to understand how to manage their capital better, they got past that hurdle. I guess I've always thought of it as like survivability, right? You're going to take a bunch of cuts in the market, and I'd rather take a lot of tiny cuts that I can withstand than get sliced right in the middle and be done for forever, and never want to come back to it. So this is a dangerous game. We're going to get cut over and over and over again. So you may as well be guarded and prepared for getting stabbed.
Right. Well, for having kids is what having kids, and the Nassim Haramein's Incerto series about uh, essentially about anti-fragility, about risk management, about that sort of concept, really taught me that, like, I don't care if my kid falls down 100 times in a row, as long as I've made it so that it's a safe enough environment for him to fall down. But he can't run in the parking lot. If he runs in the parking lot, a tail event is far likely to occur, and I got to make sure that doesn't happen. So as long as I'm making sure those things are happening, then get yourself hurt as much as you want, because that's how you're going to learn to get better and better and
Yeah,
better.
I love that analogy. Effectively, that's controlled risk, right? Like you're saying, I'm allowing my child to get hurt, but only in an environment where I know that the tail events are very, very unlikely. Like there's not, like, what's the worst that's going to happen in a backyard? A eagle's going to swoop down and steal your child away.
All right. Well, if that ever happens to me, I go, look, Zeus wanted that kid, and he's got to go. That's what he was there for.
That's funny.
All right. So next up, something more specific for TradersPost. I was wondering if someone sends a quantity. So in the JSON payload that's sent to TradersPost, if someone sends a quantity to exit a position,
Mhm.
and that quantity is greater than the size of the position, will it enter a short? Will it flatten the position, or will the trade get rejected?
Uh, there's a few different scenarios here that can play out. If you're sending action equals exit, it doesn't matter what you send as your quantity. We're going to ignore that and flatten your open position. So if I have an open position in Microsoft for 5 shares and I send an action equals exit in a quantity of 10, it's still just going to sell 5 shares and flatten my position, because action exit literally just means I want to exit my open position, whatever direction it's currently in. If you are if you have a trading strategy that's allowing both sides, however, and you send a sell signal and you have an open long of 5 shares of Microsoft, and you send a sell of 10 shares, and you're able to short Microsoft in your account, then yeah, we're going to reverse that position, and you'll be negative 5 shares instead of 5 shares long. So it really kind of depends on the trading strategy settings and what you've allowed to happen in your account. For scenarios like this, though, where you're sending payloads and you're not quite sure how it's going to play out, feel free to reach out to us and support. We can look at your trading strategy settings and like walk through the different scenarios that can play out.
So even if someone uses use signal quantity, if they send action exit, it'll ignore that quantity.
Yeah, exactly.
Oh, okay,
And that's because the action itself supersedes some of these other parameters. The action is the first sort of rule that we follow that follows the flow chart of actions that take place afterwards.
understood. Okay, yeah, that makes sense. All right. So next up, someone was asking on Discord if at the start of a new candle, if they can send a buy limit order for $2 above the current price and a sell limit for $2 below the current price, and that if one fills, the other one gets canceled. Can we do these types of bracketed complex orders?
Yeah, as long as the broker supports that style of order, then yes, you can. We have many different types of order rules that you can send through, for lack of a better word. In the JSON payload, if you go to our webhooks section of our documentation, you will see that there's a whole host of different rules that you can send in. The buy limit order would essentially be a stop entry. You'd send a stop order, and it would be a stop order at a limit price above the current market price. And then you would attach a trailing stop to that as well, or not a trailing stop, but a limit stop order to that in order to get this type of trade to execute.
It's so interesting that uh, TradersPost is essentially like the DLC for the different brokers. It's like your whatever you can do is it's not just dependent on what TradersPost can do, but also the features that are available at the broker. 'Cause I would go on these websites and be like why are there 15 different types of brokers? Why isn't it all just Pareto distribution coalescing into one broker? Well, it's because they have different features that they're catering to, and
Mhm.
that and Traders Post is this DLC that you add on and be like, oh, you want interactive brokers? Well, you want interactive brokers with Traders Post. You want Tradeovate? You want Tradeovate with Traders Post. And it feels more like a game to me to see these modules that I'm pairing together. I can imagine someone having a TradeStation account and an interactive brokers account, trying to set up the same strategy, and then go, oh no, I'm going to have to set up a different subscription because the rules on this one are slightly different on that one. And I like that sort of technicality, especially come at it from a programmer's point of view. It's like, okay, I'm be able to do certain things over here and other things I can't do over there.
Yeah, and I think unfortunately it does work the other direction. Sometimes brokers have features that we don't currently support, and vice versa. We might support certain types of features, but the broker doesn't. In the case where the broker supports features that we don't currently support, we're actively trying to figure out ways to improve that. Like there are, margin rules that can be sent over with orders that we don't currently support, things like that. So we're always looking for opportunities to expand the offering in a way that makes everything accessible, every type of trade out there accessible to our customers.
Right. All right, so this is going to be a question for you. How useful is a Sharpe ratio in determining the viability of a strategy?
Oh boy. All right. So this is a loaded question, and I hope I'm not going to end up too wordy on this, but it's one of many variables that I would look at when considering the performance of a strategy. By itself, it's actually not all that useful. It's actually really easy to manipulate a Sharpe ratio because it's just an average. It's an average of your gains relative to your risk or losses, the standard deviation of your losses, and it doesn't actually separate them either. So basically, it's essentially a score of your wins against your losses, and it is possible to have really big gains and really big losses that still don't get accounted for in that Sharpe ratio. But any one of those large losses could actually blow out your account depending on your approach. So it's not necessarily one of the best things to look at. Beyond the Sharpe ratio, I'm actually more interested in the omega ratio, which is a probability weighted distribution of your wins versus your losses, or your gains versus your losses. And I think it does a little bit better of a job statistically at telling you whether or not you've achieved that, the performance metrics that you're looking for. Are my gains typically larger than my losses, so that I'm actually maintaining profitability over time? Since the Sharpe ratio is really just mean variance, it's just an average of that history, and we all know how manipulated averages can be. Like, we know how statistics can lie, if you will. So by itself, it's an okay metric to use. It's obviously one of the most popular published ratios on any investment publication, where you're comparing different types of strategies to each other. And from that perspective, I think it's useful in comparing all of your strategies to each other. If you're kind of measuring multiple approaches to the market and you're curious about which one might have better stability, then maybe using Sharpe ratio as a score, or a ranking score, is a useful metric. But I would again implore people to consider the omega ratio, because it's a better measure, I think.
Excellent. Perfect. We have a question in chat over here, which I really like. It's an open-ended question. And this person is asking, I have zero knowledge on the subject. How can I make money from trading? Keep in mind, I have zero knowledge. So
Yeah.
your first step is exactly what you just implied within the question. You got to get that knowledge. You
Yep.
gotta you got to look into it to see. For me, it was all about. I did it the wrong way. I went into trading thinking to myself, um, I was so excited by the YouTube videos and courses and people having successes, never even thinking to myself, well, no one's publishing or few people are publishing their failures, right? In this industry where you can have, 80% of people blow up their account. I'm not getting this equivalent amount of content. And I wish that someone had told me, um, basically when you open up your account, for me, what mattered is opening up an account, because the paper trading wasn't making me feel like I was part of this game. But I wish someone told me you can open an account and only put in the money there, um, like the minimum that you can, in order to execute any of the trades that you need to, because the barrier for me to actually transfer money and like make the commitment and put it inside the account, because it wasn't quick and easy, it makes it so that my risk management is already done at the beginning of it. And then it's the losing money through trading, ironically, is like the way that I learned the best. Like this, when I sell options, I'm going to lose. If I'm doing this, I'm going to lose. If I'm trying this trade, I'm going to lose. And I was like, okay, that was like way better. And anytime I won, that was like the worst possible. Like if I won and I didn't understand why I won that trade, it's the worst possible thing that could happen. Because then I just kept doing it again and again and again. Well, I'm just gonna keep doing it again because I won last time. I won big last time. Let me just do it 100 times in a row, and I'll become rich. Straight to the poorhouse with that.
I've been there too many times. I totally agree with you there. I think the tough part about getting into trading for the first time is the belief that it's kind of a skill game, right? Like, all I have to do is spend all this time, the 10,000 hours theory. If I spend 10,000 hours studying all of this, I'll get so good that I'll make so much money in markets. And that's just not how it works, because it's not just skill. What people often forget is that much of your performance over the long run is also going to be related to luck. And there's timing luck, there's exposure luck, and then that luck can also work against you, where you take a trade at exactly the wrong time and you end up on the wrong side of it and it blows out your account. So I think that there's so many factors to consider when it comes to getting into trading for the first time, and that is that this is an incredibly complex domain that isn't necessarily improved by experience or skill. There's a huge factor of luck there. So if luck is also a factor in all of this, then I would say set yourself up for the highest probability of success possible at first, which means low risk, which means longer term exposures, like just dollar cost average into ETFs every month for a while and just see how your performance is going there. And then expand into more sophisticated approaches over time as you've interpreted and understood how complicated and how random markets really are. This is, this is not the type of game where there's sort of a fixed estimate of exactly how things are going to play out, but you can fix your risk. Like most of the time, you can actually specifically define how much risk you're willing to take. And if you're consistently good at that and managing risk, I think that's where you can improve your odds of luck.
You ever do this where, as I'm thinking about it, I realize it's a weirdo thing to do, but I'll go on TradingView, I'll remove the title and any indication of what that chart is, what the time frame is. I'll randomly choose a ticker, invert the chart, and just sit and look at it and play in my mind what it would be like if I had seen, like, I'll replay it and I'll just watch it and be like, oh, I think this is going to go up, or I think this is going to go down, and just watching my emotions play out, and then realize just like, oh, I'm totally wrong. I'm totally wrong. I'm totally wrong. I find it so one of the best parts for me was just looking at the chart and internalizing the chart and seeing what the story of that bar graph was, what it was actually telling me, what happened that day, what happened that year. It was so satisfying. I would do that like at night, half an hour before I go to bed. But you ever find yourself staring at a chart and just imagining the story of it?
For sure. I mean, that's obviously what made me fall in love with technical analysis, was trying to understand the story that's being told in the chart that you're looking at and making sure that you're seeing the full picture, which is why, of course, I like multi-time frame analysis. I never just zoom in on the 5 minute chart. I'm always looking at the daily, the weekly, the monthly. What's the overall narrative here? What is the story being told by supply and demand and by volume? What I also find like sort of interesting to cover in this topic was something that I learned about during my CMT work, and that is this idea that they did a study years ago with a bunch of professional traders, and sort of active traders, and they would show them charts asking them like, do you see a trend in this chart, and what expectation do you see happening in the future from it? And they would come in and they'd offer like very thorough and deep analysis on exactly how the trend should unfold, only to discover after the fact that the charts were randomly generated by a number generator. And it's funny because, we do have this tendency of trying to look for patterns in data. And sometimes the data is just completely random. But, like what bothers me about that study is that the markets aren't completely random from that perspective. It's not just a random number generator that's pushing prices in one direction or another. It's market direction. It's the market participants pushing price one way or another. It's the trend of earnings. Like there's hundreds and hundreds of variables that go into why a price might continue in one direction or another. So while that's useful to think about, like that we can see patterns in everything, uh, it's I think it's still worthwhile to observe the trend, because that's where the money is made.
I always think to myself that the chart is a river, and I have to think not only about the flow of that river, but also the medium in which it's traveling, and that depending on what the soil is like and what the environment is like, and what have you, it'll change the dynamics of it. And so it's you were saying that the markets aren't random in the way that the test is, and in my head I go, well, the entire universe is a random number generator. And so we're just in it. We're part of it. And if we are, that means that in a fractal sense, we have uh, some expression of what we're seeing on the chart is an expression of ourselves as well. I know I'm getting esoteric, but I see it as like, if we're all part of this fractal system, then some of the equation of what's making this thing's happening is also part of who I am. And so there might be some sort of resonance there.
Yeah.
But then I stop myself when I'll see I saw a video once. I knew I went too far down the rabbit hole when I saw a video of a guy who was doing a study of technical analysis. He was like, "This is how you could do this," and he went through all A to Z like you normally see. And then
Mhm.
he goes, "And this part, you're just gonna have to trust me. You have to look at the chart, and you could sort of feel where it's gonna go."
Yeah. There's
I
traders
was
out
like,
there that make
"Whoa!"
money from feelings. I love it. I've read about those guys too, where they can just kind of feel where the market's going, and I'm like, great, good for you for being able to trust your instincts that way.
Yeah, I can't I can't
Yeah.
do that. All right.
Maybe like the big reminder from all of what I've learned from technical analysis is that it's not a predictor of future returns. That's not the point. The point is to measure what the market is doing right now. The idea is to improve your probabilities as best as possible that the next trade you take is heading in the right direction, right? But it's a measurement tool. You're To your point about measuring the flow of water down a river. That's a measurement tool. We're measuring the width of the riverbed. We're measuring the flow of the water, the speed of the water, the rapids. All of that is just measuring to get a sense of where we think that water is going to end up down the road.
Funny enough, that example, do you know Edwin Hurst from, who created the Hurst exponent?
I don't think
Um
so.
Uh, Benoit Mandelbrot talks about him inside the who basically brought fractal mathematics to the mainstream,
Mhm.
and Hurst was he was like in charge of building a dam and water reservoir system for the Nile by the British Empire, and he took the job very seriously, so seriously that he developed a process for figuring out, is that the Nile had all the records for like 1,000 years of the water levels. So he had this data that other people just don't have, and he had all the time in the world and the mandate to figure it out. And so he figured out how to, on this essentially a chart system, how to see if a move on the chart is being is responding from I forget what the term is, if this long-term memory on the data. So if past data is affecting future data in this given moment, and there's levels of that, and the Hurst exponent, when it gets to a certain level, saying, "Hey, no, now we're responding because of past data," and when it's lower, then we go, "Okay, now we're in a random territory." And he used that in order to predict the water system, and he built, I think, the best water reserve system that the Nala ever had, which is
Hmm.
what trading is like. You're seeing this trend. Sometimes it's random, sometimes it's not, and you're developing a system for when it's not random, when the trend is your friend, then you capitalize on that. And then when it's random, you sort of you find out it's random because you get hurt. Your trade's not it's not working anymore, and now it's time to pause and let the randomness pass through. Meanwhile,
Mm.
the chart looks like the chart normally does. I always thought
Right.
that was very fascinating.
Yeah. No, that's good stuff.
All right, so let's just take one question here from Peter, if you don't mind.
I saw it too.
Um, he says, "Given what you know now, if you couldn't trade, how would you make money?"
You want to take that
Um,
one, Tom?
well, first of all, if you're saying you couldn't trade in the markets, then I would trade something else. I do sports betting, I trade comics, I trade something, because there's only of the four ways of making money, the two easiest ways is to trade something, buy something low, sell it high, or to buy something and then transform that with some sort of skill or effort or what have you, and then sell it for a higher price. So I always find something else to trade because I find it to be it's where you can monetize your information. You can monetize an imbalance between two states. So I know that's cop out. I'm saying if I couldn't trade the markets, I'd trade something else, but that's essentially what I would do.
Yeah. So, okay. I'm on the same page. And I feel like because I've become a trader, I look at everything from a risk reward proposition, which, I have a history of playing poker and gambling as well. So, like, I look at everything as a risk reward proposition. If I couldn't trade, it would be similar things. I'm just looking for arbitrage opportunities. Buying anything that even retail arbitrage for a long time was like kind of a great way to make money. For many years, I was buying watches that were damaged and sort of messed up on Facebook Marketplace and Craigslist, cleaning them up because I have a whole watch repair system at home, and turning them around for hundreds of dollars more. And it was
Wow.
a great way to make a little side income because I liked the craft of watch repair, and I was paid handsomely for what little time that I put into it. And it's a great arbitrage opportunity. So I think I would still be looking for all of those types of trades, whether they are in markets or not. The idea is to put a little bit of risk in and get a lot of return out of it.
That's right. Oh man, that Incerto series from Nicholas Taleb, that anti-fragile, that sort of idea, that really cemented in my idea of tail risk, has me looking at everything through tail risk opportunities, because the right tail, like I look for right tail risk everywhere.
Sure.
Is there an opportunity to make upside potential that's like completely mispriced?
Hmm.
Like how I'm betting on whether uh, Michelle Obama will be the nominee for for president. It's like, okay, the betting markets are giving great odds on that, so I'll take it. I love
Sure.
that right tail risk. All right, so I'll just take one more from Peter, if you don't mind, and that is, would AGI destroy trading?
Oh boy.
Um, so
Okay, so
it's so
AGI, artificial general intelligence, for anybody who's
that's it.
curious. I would love your take on this, Tom. I have an opinion, but I don't know how well formed it is.
I was just actually having an argument with, or a discussion with this with someone else last night, and they were making the case that AI or AGI reduces creativity, reduces options that are out there, and makes things more streamlined, so that there's no need for a person to do something. And I thought that was something that on paper sounds like it's the case, but anyone who uses any of the AI systems, uses technology at all, realizes that it doesn't reduce the number of choices you have; it increases it. And I can imagine a situation where AI gets used, or AGI gets used within the markets with human participants, and increases the amount of volatility that's in the markets, which then creates more opportunity. Right, it's volatility that creates opportunities within markets in order to make money, not stability. Right, a stock that has two volatility and moves up and to the right steadily over time, you're not really trading that. And so, and the ultimate idea here that some people have is that the AI will come into the system, it'll all be so managed so efficiently that there'll be no opportunity for profit. Well, then you're talking about that it destroys the market, which is the ultimate volatility event. That's there's no this it's so evenly traded that there is no market to be made. Well, that's not going to happen, right? It's not going to be like, well, the price on the chart now will be the perfect price, and there's no reason to buy or sell the asset. No, we're going to increase the volatility, and we actually want that to happen. We actually want these AI systems to come to the market because it helps to disrupt current trends, current institutional movements within the market, and provides more opportunity for the roaring kitties, the Wall Street betters, the retail trader to actually find something to capitalize on something in the markets.
This is a tough one, right? It's really tough because there's so much to unpack around the topic of AGI. First off, we don't even have anything that is by definition AGI out there. I know Elon Musk makes the argument that uh, that that the current version of ChatGPT is considered AGI, but I just don't think we're there yet. There's too much contextual information missing from the way that these current LLM models work. They don't quite understand the full breadth of everything involved, and they're so easily influenced by input that they can go completely in the wrong direction and end up hallucinating their understanding. So I think it's fair to say that um, whatever version of AGI that ends up in the future, I think it still ends up another market participant that adds to the randomness and noise of the market, because there's no there's no particular scenario in which one person can corner the entire market without insane amounts of leverage and capital. And even in those scenarios, I think they're still going to be managing risk in a way that probably looks closer to delta neutral, right? Like the Citadels of the world make an insane amount of money remaining delta neutral and basically just paying for order flow and using statistical models to get there. I don't know that AGI gives them any particular leg up. I don't think it's really about an informational edge at that point. It's really about speed. Speed becomes more important than information at some point. So if they can build a connection to the brokers and to the exchanges that can trade in less than 2 milliseconds or start operating in the nanosecond territory, then they stand to make more money from that because they're first in line. So I don't know. I'm like not convinced entirely that AGI is anything that would completely change markets. because there's still just so much noise and so much participation with billions of dollars floating around.
That's a great point that the real money can be made elsewhere and easier, and AGI doesn't know the future,
Right.
so it doesn't have any edge on that anymore than you do.
Yeah.
Pretty interesting.
I like there's a scene in Westworld where they had hooked up their entire system to everyone's consciousness, and it could actually start to predict where the market future was going to go because it knew it had a pulse on the sentiment of every person on the planet, and it could kind of sense what everybody's sentiment was. We're trying to achieve that by measuring the markets through as many ways as possible so that we can gain sentiment from it. But by playing a part as a buyer, assuming that the future represents the total sum of the current sentiment of the markets, there's always going to be somebody else who wants to play the other side of that trade
That's
that
right.
suddenly
That's right.
realizes, no, 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 we think you're overvaluing this and overvaluing the future. You still have to take some kind of position, and you could still be considerably off in your position about what's happening in the future because, well, I don't know, people's minds change every day.
That's
what if
right.
what if there's a global random event, somebody bombs another country, and that changes everybody's sentiment in a heartbeat? It doesn't really matter how informed your current information is if it can be completely destroyed by tomorrow's information.
That's right. The buyers have to convince the sellers to sell, and the sellers have to convince the buyers to buy. Like
Sure.
the prices that we see on the chart is a reflection of the bid ask spread and the meeting of the two. So you're right. If there's not the meeting of the two, well, there has to be for there to be a market.
There's always going to be somebody who takes the other side of your trade. Yeah.
Yeah. I'm not sure about Ezra's question over here. If we could just try that for a second. My question
Yeah.
is, when it started to run my strategy, will it finish all of it on this cycle, or can it run one half of it and later by 10 seconds, for example, finish the current cycle? Does that hit you? I asked for clarification, but
Yeah. Ezra, hopefully I'm getting this correct. If correct me if I'm wrong, but it sounds to me like you're trying to scale out of your position. In which case that is totally possible. You can add to an existing position and you can scale out of a position, but you have to manage the number of shares or contracts that you need to sell by. So, for example, I could start with two contracts of NQ or the Nasdaq futures contracts, and then add to that position and add two more, and then I can sell one and then sell another and then sell another, and TradersPost will support that. So it totally is possible for you to set the alerts up in a way that allow you to control getting in and out of your position in a scaled way.
excellent. All right, so I guess we'll leave that there for today. Great discussion. I like the topics, like the questions that people had, and always nice to see a vibrant chat. Um, as always, we'll always be looking for your questions every week. So talk on Discord, send us support tickets, message us. We're always happy to help in any way that we can. Hope you can have a great weekend, Mike, and a good weekend to everybody else.
Likewise, Tom. Take care.